We might have just hit a major turning point for the US economy. The latest jobs report wasn't just a miss, it was a complete shockwave. And it has totally changed the conversation from, is there a slowdown, to are we heading for a recession?
This single quote from an economist at FWB Bonds really just says it all, doesn't it? For the first time since the whole pandemic recovery kicked off, the engine of the US economy has just stopped. So let's dive into the numbers that set off all these alarm bells. So in August, the US economy added a shockingly low 22,000 jobs. Now, to give you some context here, economists were expecting something around 75,000. This wasn't just a little miss. This was a massive red flag that the labor market is in real trouble. But honestly, the real bombshell was hidden in the revisions to the older data. The number for June was revised down to a loss of 13,000 jobs. And why is that such a big deal? Well, it means the historic job growth streak was already over 2 months ago. The post-pandemic expansion officially came to a halt, and we didn't even know it at the time. And all of this pushed the unemployment rate up to 4.3%. That is the highest we've seen since 2021. So this just goes to show you that the weakness isn't just in the hiring numbers, it's really starting to be felt across the entire labor force. Okay, so those headline numbers are pretty alarming all on their own, right? But believe me, that's just the beginning. Once you start to peel back the layers of this report, the picture gets even more concerning.
The end of the job growth streak is, of course, a huge symbolic moment, but the weakness runs a lot deeper. Take the U6 unemployment rate, for instance. This is the one you really want to watch, because it includes people who are underemployed or have just given up looking for a job. Well, that rate just spiked to 8.1%. And this isn't isolated either. We're seeing job losses in key areas like manufacturing and even the federal government. So, how did the financial markets react to this shockwave? Well, it was a total roller coaster, a perfect example of Wall Street trying to figure out what to do with bad news in real time. So, right when the report dropped, stocks actually shot up. The initial thinking was, okay, bad news for the economy is good news for stocks because this forces the Federal Reserve to cut interest rates. But that optimism didn't last long. By midday, the fear that the economy was actually genuinely heading for a recession started to outweigh any hope of a rate cut. And as you can see, the market finished the day in the red. Now, check out how the bond market reacted. Unlike the stock market, there was zero confusion here. Investors absolutely rushed into the safety of government bonds. And when demand for bonds goes up, their yields go down. The 2-year yield, which is super sensitive to Fed policy, hit a 5-month low. This is a classic flight to safety, and it's a clear vote of no confidence in where the economy is headed. If there's one thing this report did, it was locking in the Federal Reserve's next move. Before this, there was still a little bit of a debate. Not anymore. The market now sees a September interest rate cut as 100% certainty. It's a done deal. The only question now is how big that cut is going to be. So a rate cut is coming. But here's the thing, that might not be enough if the problems are deeper than just a normal slowdown. So we have to dig deeper and ask, why is all this happening right now? Well, the manufacturing sector is a glaring red flag. It's now lost jobs for 4 straight months, shedding 78,000 positions so far this year. And a lot of economists are pointing their fingers directly at policy. All this ongoing uncertainty from tariffs is making it pretty much impossible for businesses to plan ahead. And get this. Research from the Federal Reserve itself has shown these policies have a direct negative impact on manufacturing jobs. As you can imagine, this has turned into a political blame game. The White House came out and suggested the weak numbers are because of shifts in immigration, arguing that jobs are being created for U.S.-born workers. But economists were quick to jump in and say, hang on a second, the actual data tells the exact opposite story. The unemployment rate for U.S.-born workers just hit an 8-year high of 4.6%. Okay, so this brings us to the crucial point. The U.S. economy is now standing at a massive crossroads, facing 2 very different paths forward. The Fed is going to act, for sure, but the big question is, will it even be enough? This leaves us with 2 competing scenarios for what happens next. The optimistic path is what they call a soft landing, where the economy slows down but manages to avoid a crash. The pessimistic path? A full-blown recession, where today's problems just spiral out of control. The soft landing scenario, well, it pretty much rests entirely on the Federal Reserve's shoulders.
The hope is that by cutting rates in September, and then probably again in December, they can pump enough stimulus into the system to stabilize the job market and get businesses investing again. The catch? They have to do all this without letting inflation get out of control again. It is a real tightrope walk.
The recession scenario, on the other hand, argues that the Fed's tools just aren't going to cut it this time. The fear here is that the problems are structural. Businesses are so uncertain about policy, everything from tariffs to government spending, that they've just frozen in place. They're not hiring, but they're not doing massive layoffs yet either. It's like the whole economy is stuck in this state of paralysis that cheap money from rate cuts just can't fix. So what's the big takeaway from all of this? Well, while a soft landing is still technically possible, the evidence really suggests that the U.S. is facing a much more challenging road ahead. The analysis really points to the idea that because the root causes are so tied to policy uncertainty and these bigger structural shifts, a recession is probably the more likely outcome. This isn't just a normal business cycle slowdown. It's being driven by things that are absolutely crippling business confidence, and that's a much harder problem for anyone to solve. And this quote, man, it just perfectly captures how fragile things really are. When you dig into the details of the jobs report, you find that almost all of the net job growth is coming from just one sector, healthcare. As one economist warned, it has become the only pillar holding up the entire U.S. job market. If that one pillar starts to wobble, the whole thing could just collapse. So this leaves us with one last critical question. The Federal Reserve can lower the cost of borrowing money, but it can't create stability. It can't resolve trade wars or give businesses a clear idea of what's next. So as long as this deep, paralyzing policy uncertainty continues, can a true, sustainable recovery really even begin? Thank you for watching.